This is Tom Aspray with the Viper Report market wrap video for the week ending February 13th. Fear or greed? That's often a tough thing to measure, particularly during market corrections. As those of you who read some of my many articles on sentiment say that when the longer term trend based on the AD lines is positive, then pullbacks within that uptrend can be timed by looking at the rising fear and the diminishing greed. Currently, the CNN measure is at 36 in the fear category. And, this index, to me, if you look at the components, not really necessarily a fear and greed index, but it's an interesting measure. This weekly chart of the SPY shows that it was down 1.3% on the week, still holding above the 20-week EMA that's at 675.37. And of course, there's stronger support going back to late last year in the 655, 660 area. AD line continues to make new highs. Volume did pick up in the past couple of weeks as the market moved lower. And below this, we can see last week, the bullish percent based on the AAII survey dropped pretty sharply. So the differential, that's the bullish percent minus the bearish percent, dropped to 0.40, pretty much neutral. So same number of bulls and bears. We'd had a nice peak up here above 20. I thought we were going to see a further push to the upside before a correction. With the close below the moving average, that's probably a less likely. Of course, the maximum great buying opportunity last spring that forced many people out of the market is seen here. The bull minus bear got down to the minus 40. So 40% more bears than bulls. That's the extremes you want to capitalize on. Of course, whether you're feeling more fear or greed is likely determined by what markets you were in at the start of the year. This is a chart of the IGV, that's the iShares Expanded Tech Software Index. See, early the year, it opened below the monthly pivot here at made one high here at 107.30, and it's now at 107 or at 82.77. Quite the plunge. If you instead were in, SMH, the semiconductor, you're probably not feeling too much fear. You may be worried about greed. You can see it's made, a high here at 420.60 and at 420.20, a little lower than that. So, that's the OBV here is starting to look a little like it's losing some upside momentum. So we'll be watching for a pullback in that. You can see major support for the SMH is around this 374 area. That'd be about an 8% decline from where we are now. The tech decline has pushed the QQQs to close down below the 20-week EMA at 606.76. It closed the week at 601.92. The yearly pivot here is down in the 550 area, and there's support also around 575, 580. The AD line is still positive, hasn't made much progress so far this year, but still shows a major positive trend. And the RSI has dropped below the moving average, suggesting at this point the Qs are not leading the S&P. From the April lows, we had a strong positive signal, and we kept making higher highs. Into November, that favored the Qs over the SPY, but then at the end of the year, that changed. Looking at the daily SPY chart, you can see we made it down to the S1 there, as well as the 100-day moving average at 677.98. A decisive close of that would likely increase the fear levels of the traders, suggesting we get back down to this S2 level, which is at 6. On the upside, still 601, 610, and but if you look at the technicals, they do not show formations consistent with a further correction. More likely, they do favor the upside. You can see, a barely positive close on Friday. Look at the AD line of the S&P, made a new high. Stocks only on the NYSE, very close to a new high, and a new high in the NYSE all. So all those measures are positive and are a sign that more stocks are advancing than declining despite the price action. Of course, the NASDAQ 100 has had a rough time, even worse in the NASDAQ composite. You can see it's closed further below its 20-week EMA. If you look below here, we have the spread. Also shows that, in the past 3 weeks, it started underperforming the SPY. So if the market, is going down, the NASDAQ composite is declining more than the SPY. On balance volume also looks negative, and there was a divergence, early at the start of the year. And the AD line obviously looks much different than we did in the SPY, and it's still, forming, it's in a downtrend here. So, I'm looking for the support in November. That should hold, and there's some signs early at this point that the washout, for example, in the software stocks is maybe close to over. One of the measures that I follow pretty closely is the what I call the 90% chart. So looking for an extremes in selling, like we had right, at the start of the year, based on the S&P, over 88% of the stocks were lower. On the Qs down below was even stronger, closer to 100%. And then that was pretty much the selling. We rebounded back from that. Overall, the more advancing stocks than declining since then. And even the Qs bounced, 44% were positive on Friday, 46.8 or something on the SPY. Looking at the high-low analysis, no concerns here. Big surge in new highs on the NYSE above 400. So it's showing a nice positive trend. And no real extreme pickup in the new lows. This high around 200. So a couple of strong moves above 200 new lows on the NYSE would be a reason to be concerned. And on the NASDAQ composite, you can see it didn't make a new low here in February, only 400. They were like 550 or something earlier in January. Had kind of a spike in the new lows here at over 500. So, that's something, if we make another move above this high, that'll probably just confirm that we're going to see a further correction. The growth value still favors value. You can see this is the IWF IWD ratio. So, when the ratio is falling like it did in 22, that's positive for value, negative for growth. Since then, it was pretty much positive for growth until we started to top out at the end of last year. It's plunged further, getting down to a support area, suggesting that in the next 2 to 4 weeks, we should get a bounce. Whether it's a resumption of the overall uptrend is looking a little less likely, but we'll keep trying. You can see the MACDs are quite negative, but they are also getting quite oversold. We had a classic bottom formation in early 23. There is a bit more fear evident in the VIX and the VXN volatility indices. You can see that the VIX closed above 20 and, still shows a pattern of higher lows and higher highs. So, a move above 22 here, will suggest a challenge of the 29 to 30 area, which is where the VIX stalled in November. The VXN, as you might expect, is acting even stronger than the VIX. It hit its moving average and turned higher. So it also shows a positive pattern. Remember, this is when it's rising, it's not a good thing for stocks. There has been a bit more interest on the put side here. You can see the total put call ratio is at 0.94, still more calls than puts. But however, the index is at 1.13, indicating that there were 13% more puts purchased than calls. I should stress that this current decline, even if it does get more severe, is likely to be a rotation in the overall market. And as a result, we have very few growth ETFs in our portfolio, but quite a few value and other interests. Last week, you can see we had weekly DTS in the biotech, a couple different biotechs, the SPXL, that's the bullish triple leveraged, SPY, TBT, the bond, VTI, that's the Vanguard World, Vanguard or SPDR Biotech, as well as the UPRO, which is the leveraged S&P short, TLT, and in the green side, besides DLT, we had the two utility ETFs here, and also these in red here, there are three short ETFs based on the S&P. Over 70% of the ETFs did close above their quarterly pivots, but you can see it was a value market, growth gauge at 30, value at 81.8, and if you look at the inverse, a slight favor to the short ETFs, not the long ETFs after last week's action. Looking at the sector report, AMT, CCI, and AWK all gave weekly buys as well as 3-day buys, and then there was T-Mobile also, right? And if you go down here further, a combination of utility stocks primarily and a drug company or two. We're seeing some positive signs in the pharmaceuticals that we mentioned last time, and we look down here. Of course, this is the all-important grid, that we're kind of looking at the RS, very strong on energy. We've been avoiding this sector for a while, but got back into XOP, the oil and gas exploration has done very well. PSX is one that just turned positive in the hourly, so it's one of the few red ones here, as is Schlumberger. So maybe take a look at those in the week ahead. Materials also strong, of course, helped by gold, and looking very strong here. And chemicals, Dow is very strong. Also in the industrials, a bullish pattern we've been commenting on in the industrials. Staged a breakout last week, and there's still some spread there. So Deere, ADP, UNP, Union Pacific, and CSX, so a couple of railroads have some short-term weakness. Ideally, in those strong sectors like industrials, you look for a combination of 4-hour DTS negative and DTS, and then look for that to reverse back to positive as a buying opportunity. That's worked out quite well for us in many of the markets. Stocks have been an easier pick recently than ETFs. So consumer discretionary shows a negative trend, 58%, so just below that 60 level. And Tesla has got a little green. Nike does too. And but then there's kind of a mix. So Starbucks here, It's got a daily DTS, so is that gonna flip to a 3-day? If so, that's a negative sign. So, you'd want to see, some green here if you were thinking about getting a new long. Um, Same thing for CMG, though it looks much worse. And then consumer staples, of course, extremely strong. PEP, and we're in Coke and the stock side here, and healthcare. Yeah, the chart of the consumer staples looks great. Healthcare longer term, I think, still looks very positive, but it's in a range here. So we'll be looking for a sign of a breakout above these two peaks in the coming months. That a sign that that healthcare is back leading. Financials beaten down 27.3. I think this is one that's getting probably within a couple of weeks of bottom, so we're watching it closely. Technology is probably a few steps behind that, and communications, it bounced last week, so it's but still 45.5%. Utilities don't get much greener than that, and real estate also is looking quite friendly. And of course, to go to the Viper report, we'll be updating the current positions. We took some nice profits. Curtis White and Darling have been stellar performers, and we've added a few new positions that look equally encouraging. And of course, the ETFs, will be updating this before the start of the week, so you can see what we're currently in if you're not a subscriber. And also, always look to the Viper report for new articles. Thank you very much for tuning in, and as always, please send me your feedback.